In this video, guys, let's address this interesting question. Should we all be trading smaller markets? Stay tuned. Hey traders, warm welcome to you. Thank you for joining me. All right, so this is an interesting one. Should we all be trading smaller markets? This is a question that's kind of posed, and I thought, that's interesting. What do you mean? So smaller markets was defined as a market that's less liquid and has less attention. So not your major currency pairs, not your Nasdaq, not your Dow, not your DAX, not any of these big things, but smaller markets like maybe an unusual commodity that not many people trade, or maybe a smaller, less liquid stock. Now, there is a kind of commercial response to that. Well, the liquidity is an issue, but let's imagine for a second that liquidity wasn't an issue, but it was just a less exciting and sexy instrument, right? It was a stock that not many people traded. Maybe it was a currency pair not many people traded. It was an exotic pair. And assume for a second that spreads and stuff were fair and reasonable, and you could kind of get access to that, which is a bit of a big assumption, but let's assume that for now. The argument is, well, actually, aren't these big markets overcrowded? Like, why are you trading Nasdaq when everyone's trading Nasdaq? Why are you trading SPU when everyone's trading SPU? Why are you trading? You get the idea. And so it got me thinking. I was like, you know what? There's something to be said for that. There's something to be said for that. But the answer is this. The answer is this: is that you can trade these bigger markets, and the way that people do well in those and how you do well in those is that you are very, very specific about when you get involved. Because if you think about people who trade a very, very small market, right? They trade a small market, they're specialists in this very unusual small market. They're probably not trading all day, every day. They're probably trading under some specific circumstance that has a certain catalyst, a certain structure. They go, hey, that really works really well in that, I'm gonna trade that. But the trouble is, when people are trading Nasdaq, they're trading cable, they're trading Euro USD, we tend to overtrade them. We tend to see stuff that's not there, and that in itself is the cause of poor trading and poor results. If we treat it as if, okay, listen, 999 times out of 1,000, I don't want to get involved. Let everyone else get involved. But the one time out of 1,000 in that trading day or in that trading week, maybe 1,000 is a bit of a big example, we get the point, is there's an edge, then we can strike, and we don't need to go to the smaller markets and become a specialist in those. We can be a specialist in the big, thick markets, enjoy the liquidity, enjoy the tight spreads, enjoy everything that comes with that, but just treat it as if it has to have a very, very specific set of circumstances for you to get involved. So then you eliminate overtrading. You say, hey, yes, it is a big market, that's fine, but I only trade it when we've done a high break, a low break, a this, that, the other, and then we kind of stall at the VWAP. I like that, or whatever the structure play is. And you build these little plays and you say, hey, I am treating as if it's a specialist market, because it is. Even though the broad market is big and fat and there's loads of juice and liquidity in there, it's all very nice. In actual fact, there are certain parameters that I need to see to trade it. And so the question is a good question. It's like, okay, well, as retail traders, why don't we go and play in some of these thinner commodities? Why don't we go and play in some of the lesser known stocks and find the edge in there of institutions moving? And there's an argument for that. There's an argument to say, hey, if you're trading what everyone else is trading, you're just battling in this massive pond trying to be a little fish in a big pond, you get swallowed up. And I agree with that to a certain extent. But the people who do well are the ones that have a little section in that massive pond that's theirs. They're very good at trading that open. They're very good at trading around the VWAP. They're very good at scalping against a prior day's high. They're very good at trading little mini bull flags on a 1 minute chart after a 5 minute dry. Whatever it is, that's where the edge comes in. And so you don't have to go, I need to go to another market because everyone's trading that, and I want to get an edge in a smaller market because then I'll be a bigger fish in a small pond, and I'll be able to have some sort of credibility in there and structure in this and the other. And that makes sense to some degree, but you don't need to think like that. I think this is a valid question, fair play to the person who asked this question, but actually it's trading the bigger markets, but not trying to compete on that big level, not trying to compete in an HFT format, ultra high scalping all the time, not trying to get every single move and every single swing, not trying to compete at a level, just finding your little area where you can compete. And it can almost be a small market for you. Like, hey, I do really, really well 2 hours before the opening bell on the Nasdaq futures, for example. That's my edge. That's where I specialize in. That's where I operate. And when you think of it like that, it can become a small market, because yes, it's a big, massive market, loads of liquidity, loads of volume, etc. But you've got a little chink, a little corner, and that massive pool where you're protecting and you're carving out an edge. And all of a sudden, it becomes a game that you can get good at. You can carve yourself an edge out, and you can become one of those top 1% of traders out there. Take care. See you next one. Bye bye.